Students, yes, very good afternoon to one and all. Good afternoon, Ankit, Hardik, Shruti, Pranav, Neeru, VR, Nikitana, Jinky, Nitin, Pranav, Ankit, Preeti, Tambeshwari, Abhishek, Nagraj, Manvi, Anjali, Neha, Dilip, Praveen. Yes, very good afternoon to you all, Bhavna. So let us start. So students will just complete the remaining part of HP head, and then we will proceed to the PGBP head, my most favorite head of income. But before that, let us first take your queries. If anything you wish to ask, any questions that you have, Gaurav, Harpreet, Dilip. Yes, tell me if there is any question, let me know so that we can discuss that and we can start with our next topic. Yes, students, anybody, any queries? Some questions are not about, okay, yes, I'll answer that. Great, Hardik. So there is a very good question. Riddhi is asking, sir, if in the question they have not mentioned about the regime, whether you have to go by the old regime or the new, that is the default regime, then generally students, it is your choice. You can answer the question as per your choice. But anyways, if we have to go logically, if nothing is mentioned, then it has to be the default regime. And anyways, if you go by the whether it is easy or difficult, then again you'll find that the new regime solving is easier because then the headache of adjusting the 2 lakhs is gone. So in any case, if nothing is mentioned, you should go by the new, that is the default regime, because anyway, since it is default, it means nothing is mentioned. So you go by the default. Just make it a point that you should write a note that this is solved as per the default regime. Had this been the old regime, that is the assessee has opted out of this default regime and has gone to the old regime, in that particular case, this would have been the answer. See, this difference is created only in one scenario, and that one scenario is self-occupied house property, and that also the interest part. That is the only difference which you can mention in one line. Oh, great. Aniruddha is saying all questions solved. Excellent. Sir, by the name suggests default means if the assessee does not choose any regime. Exactly, beta. So now the new regime, which was 2 years back, the new regime was optional and the old regime was default. Now, they introduced section 115 BAC bracket 1 capital A 2 years back. Now, because of this section bracket 1 capital A, that is subsection 1A, this new regime has been made the default regime. So if nothing is mentioned, if you are not specifying as an assessee which regime you are opting for, then it is by default the new regime. That is why it is called as a default regime. Yes, Praveen. So this is what I'm also mentioning. So if nothing is mentioned, you should anyways go for the default regime for two reasons. One, logically also default regime is there if nothing is mentioned, and practically also because solving is much easier in the default regime. So I have one more question. Kasak is asking, sir, if expected rent is GAV, then unrealized rent is deducted from it. Oh, great. So Kasak is having a good question. Now see, students, generally I prefer going by the law, that is the Bare Act, right? So Kasak has raised this question. Sir, if GAV is the expected rent, and let us say you are given the unrealized rent also, are we supposed to reduce the unrealized rent from the expected rent? Now, see, students, whenever I get this type of question, it is my habit to go to the Bare Act, right? Which is the best source to get any answers wherever you have a doubt. Obviously, I agree to this also that everything is not there in the Bare Act because many things have come out of interpretation. But these things are very basic or very much there in the Bare Act. So I've already opened the Bare Act for you. I had kept it on my screen so that I could also myself take you to the Bare Act because this is what I always prefer. 1 second. I'll just open the Bare Act screen. Yes, I think it's here. So let us read the Bare Act to get the answer to what Kasak has asked. And this, I students will request everyone to develop this habit, that you should have this habit of reading the Bare Act for all the legal related subjects, even now as a student, and definitely in future whenever you are into the profession. Now see, I'm reading 23.1, which is the section for GAV. Now, from here, we will be drawing multiple conclusions, and I will request everyone to be active, to be live, so that the questions which I'm asking you all are ready to answer. Now, see, we know major part of the HP now. Few theoretical point is left. That is anyways I'm going to cover today. But before that, now since Kasak has asked this, so let me take you to the Bare Act, section 23.1. The heading is annual value how determined. See, headings you should read, you should understand what it is dealing with. Now, for the purposes of section 22, now we all know 22 is the charging section. So when they are saying for the purposes of section 22, it means this particular section or the meaning or the computation that we are studying over here is limited only to HP head, because 22 is the charging section of HP, and this section starts with saying for the purposes of section 22. Now see, this is how you interpret the law, because many times when you read some other section, if it is not having this type of a starting, it means whatever is mentioned over there will apply to the whole act. Whenever you read the act in toto, wherever the word appears, it will have the same meaning and the same working will apply. However, here it is specifically saying for the purposes of section 22. So the meaning is limited to charging section 22, which means it is limited only to HP head, which also means that this computation will not apply to other heads, like where your income from a property gets covered under other sources. Like now we have already discussed that in first lecture, when it is not covered in HP, in some cases it may go to other sources. And in many cases where it is not covered in HP, it will go to PGBP. Now, when your case gets covered under any other head other than HP, like as I said, other sources or PGBP, this computation will not apply, right? So be clear with this. Hardik, you have said mutatis mutandis for what? Okay. No, but mutatis mutandis does not mean in toto. See, mutatis mutandis means if I'm saying anywhere that this section is mutatis mutandis to this, it means that mutatis mutandis means it is same in the other case also with necessary changes. So let us say I read it like this. The meaning of annual value is mutatis mutandis to this section of other sources, or this section of PGBP. It means that whatever you are reading here is same what you have read there, only with necessary changes. Necessary changes means wherever they are using the word HP, you'll read it here as PGBP, or wherever you are reading it here as PGBP, over there you'll read it as HP. That is what it means. Otherwise, the entire provision is same. So mutatis mutandis means same with necessary changes. So whenever you want to say that, okay, what I'm reading now is already what we have read above, so you can simply say it is mutatis mutandis to the above section. This reduces your time to repeat the whole thing. That is what is the meaning and importance of mutatis mutandis. Okay, there is a question from Neha. I'm reading a question for everyone just so that everyone can now see. Now you all are, I'll say, very much well versed with the subject. So when I'm now reading a question, everybody please pitch in with your answers so that you can also test where you are standing in the subject. So Neha's question is, sir, if an employee has only salary income and he has taken a loan on his house property, and his parents are living in that particular house. So some basic details, you are only a salaried person. You took a loan for purchasing a house. In that house, your parents are staying for the time. And he is also paying rent on the house. Now here what I'm understanding from this doubt is he and his parents are staying separately. So parents are staying somewhere in the village or in some native place. And this person has come to some city place where the person has taken up this job. And in that place, the person is paying rent, right? Is there any exception allowed specifically for that employee? Now, but I don't know what exception you are saying. I'll tell you what are the provisions. See, in the salary chapter, you all have studied a scenario called as HRA, house rent allowance, where if again you are going by the old regime, in HRA, you are allowed exemption, which is least of three. And those exemptions are allowed least of three, where there is interestingly a very important requirement that you cannot take two benefits at the same time. What are the two benefits here? For one house, you are taking the benefit of HRA exemption. And at the same time, for another house where you are staying in a rented house, you are also taking the benefit of the rent paid of that particular house. So both benefits cannot be taken. Either you can take HRA benefit or you can take the benefit of rent paid for that particular house. So I think, beta, you are asking that particular question. So this is what, according to me, my answer is whatever I've understood from your query. Okay. So now let us together read this section. I'm sure now you'll be able to understand a lot from this section. So as I said, for the purposes of section 22 means that this definition, this working will apply only to this head. The annual value of a property shall be deemed to be. So first, it is a deeming provision. Why it is a deeming provision? Because here, besides actual value, you are also taxing a deemed value. So they have said that whether or not this is real, it makes no difference because anyways, we are deeming that the value will be. So it may be a possibility, this we discussed in the previous lecture also, that you are paying tax on notional income. Yes, Hardik, you're right. So there is a possibility that you may be paying tax on a notional income. So for the purpose of this section, annual value of the property shall be deemed to be 1A, the sum for which the property might reasonably be expected to let. Now, what is this reasonably be expected to let? See, start posting your answers. This will show me whether you have understood whatever you have studied in HP till now. Okay. I have one answer on this. Any other answer? So 23(1)A says that your GAV, which is over here, the annual value, could be 1, the expected rent. So if you remember in GAV calculation, we take higher of the two, right? AR, ER. So this is what they are talking about, ER. B part, where the property or any part of the property is let and the actual rent receivable by the owner in respect thereof is in excess of the sum referred to in clause A. So now they are saying where actual rent is in excess of clause A. Clause A is what? Expected rent. The amount so received or receivable. In other words, clause B says where actual rent is higher than ER, then GAV will be actual rent. Now comes the interesting part where beta you will get your answer. Kasak, where the property or any part of the property is let and vacant during the whole or any part of the previous year, and owing to such vacancy, the actual rent received or receivable by the owner in respect thereof is less than the sum referred to in A, that is ER, the amount so received receivable. So this is what we have seen, that where AR is lower than ER, but only because of vacancy. In that particular case, we will consider that particular AR only as GAV. Okay. Now, there is a proviso. I'll come to proviso in a minute. Let me first give answer to Kasak. So Kasak's question was whether unrealized rent will be reduced from expected rent. That answer you get from the explanation. What does the explanation says? For the purposes of clause B or C of this subsection, the amount of actual rent receivable by the owner shall not include, subject to such rules as may be made in this behalf. What it will not include? The amount of rent which the owner cannot realize. So now I want everyone to give me answer to Kasak's question, that where in some scenarios where your GAV is ER because ER is higher, then in those scenarios, whether unrealized rent has to be deducted from ER. You have to say yes or no. You can write Y for yes, N for no. Kasak, you're writing yes. Deepak, you're writing yes. How come yes, beta, Kasak and Deepak? Because others have said no. Aisha is also writing yes. But I have already underlined what is important. What it says, for the purposes of clause B and C. And what are B and C? In B and C in both clauses, what is your GAV is your AR. So it means when they are saying for the purpose of clause B and C, it means they are only referring to the cases of AR because ER is covered in clause A. So they have very specifically answered, Kasak, your question that wherever ER is higher, unrealized rent cannot be deducted. Is this clear, Kasak? And I hope everybody is also able to understand from this language of the law. Good, Kasak. Now, I'll just read the proviso also. What does the proviso says? This is also what we discussed in detail in the first lecture when we were discussing the format. Provided that the taxes levied by local authority. Now, which taxes they are talking about? They are talking about the municipal tax. Now, again, important. The law has not used the word municipal tax. It says taxes levied by local authority. Now, many people were asking me in that lecture, sir, whether water tax would be deducted, whether sewerage tax would be deducted. The answer is yes, because all these taxes are levied by the local authority and they are levied in respect of the property. So there are 2 points to be noted. One, taxes are levied by local authority, and two, it is in respect of the property. So where both these conditions are satisfied, whatever is the name of the tax, whether property tax, whether municipal tax, it shall be deducted. Okay, now the main point. Irrespective of the previous year in which the liability to pay such tax was incurred by the owner according to the method of accounting regularly followed by him. So it is irrespective of the year in which the tax becomes due, right? Because this tax has to be deducted on payment basis. How? So in determining the annual value of the property of the previous year in which such taxes are actually paid by him. Now you remember there are two conditions for municipal tax. Once it is paid, two, it is paid by the owner. Both are appearing from here. The year in which it is actually paid, so the payment is required, and most important, they could have put a full stop after paid. Had it been a full stop after paid, it would have been paid by anyone. Then even if the tenant is paying, you would be getting deduction. But further, the law says paid by him. Him means the owner, because we are talking about the owner in the above line. So it means that wherever municipal tax, which means the taxes levied by the local government, are given in the sum, irrespective of the year in which it becomes due, that is, it is incurred, you will be allowed deduction. Fine, students. I hope this is very, very clear to everyone, right? Now, subsection 2 is about what? Now, I think here, Neha, I think was the person who had asked that question. Neha, I think you will also get your answer here. Relating to your doubt of that employee's parents, right? To some extent, I think you will get answer over here. Yes, Manoj, beta, municipal tax paid by owner only. This is what I'm trying to explain, right? Who had asked question about employee? Yes, Neha. So just pay attention, Neha. What is written here? So subsection 2 deals with what? Where the property consists of a house or a part of a house which is in the occupation of the owner for the purpose of his own residence. So either where the employee, like in your case, who is the purchaser or the owner of the house is himself staying, or cannot actually be occupied by the owner by reason of the fact that owing to his employment, business, profession carried out in any other place, he has to reside at that other place in a building not belonging to him. So the owner, that is the employee, is staying in some other city or place. Now, in your question, Neha, you are saying that the parents are staying. So that is fine. Most important thing is that where parents are staying in that particular property, then also you will be eligible for the benefit of two self-occupied nil. If you remember that the GAV of two self-occupied is taken as nil. In fact, that is also written over here that up to two self-occupied, you will take nil. So where it is written, see, the annual value of such house or part of the house shall be taken to be nil. Now, where it is given that it will be only for two, that is given in subsection 4. So where the property referred to in subsection 2, what is subsection 2? Either you are staying or you have shifted to some other city for the purpose of your job or employment, and either that house which is the owner, which is your own house, is either closed or maybe your family is staying. In such cases, it consists of more than two houses. So from here we get to know that up to two house you can take the benefit of subsection 2. Beyond two house, what will happen? This is what we solved in the previous lecture. Beyond two houses, what will happen is you will tax the house over above the two. Like in our case, the third house, we taxed it by treating it as deemed to be let out. That is written over here. So where the property referred to in subsection 2 consists of more than two houses, the provision of that subsection shall apply only in respect of two of such houses, which the assessee at his option may specify. That is why if you remember in that sum, we had three options: 1, 2, self-occupied; 1, 3, self-occupied; 2, 3, self-occupied. Now, out of the three options, we find that the most beneficial position is in option 3. So we opted for house 2 and 3 to be self-occupied. So again, the law itself says it is at your option that you need to specify which one you want to treat as self-occupied. And then most important, the deemed to be let out part, the annual value of the house or houses other than the house or houses in respect of which assessee has exercised the option in clause A, that is of treating it as self-occupied, shall be determined under subsection 1 as if such house or houses have been let out. This is what we have termed as deemed to be let out. I hope this is very, very clear to everyone. This is what the law says, right? I'll take few questions and then we'll go to the remaining part of our topic. But sir, in SM in illustration 7, they deducted the unrealized rent in note mentioned alternative way. But Kasak, I'll just check that to see what they have done, right? And I'll revert back to you on this. Praveen, sir, my doubt is if the question gave municipal tax 2000, then it mentioned water tax 500. In this case, should we assume that water tax is already under municipal tax? No, beta. I believe in this case, you will take 2500 and you can write the assumption that you are assuming that water tax is not included in. So this will be my preferred answer. Sir, if any changes happen to my annual finance act, will the website also change on it where to find old act and new act? But in this, the place where I'm referring, you find all the acts. I'll show you how. Riddhi. Aniruddha, tax all three as deemed to be let out, then take the three cases where two PH are self-occupied. Yes, but this is what we did, na? Aniruddha, this is how we did, right? Riddhi, see, this website will give you all the acts, the present and the old. See, I'll show you. Now see what it has given. Income Tax Act 1961, amended by which Finance Act 2024 number 2, because this year we had two budgets because of the election pre and post. Now here, Riddhi Beda, you have option which year's budget, which year's amended act you want to see. So they have given you, see, from so many years, right from 1961. So if you click here, just out of interest, huh? Just if anybody is interested. Now see, if I want to see anything here, I'll just show you that section 18. If you remember, I had mentioned that earlier we had section 18, which is now deleted. Now see, you have this section 18, interest on securities. It was there in the original act. Later on, it was removed and it is merged with other sources. Fine, Riddhi. So this site will show you all the acts and you can go to any year's act and find it. Yes, Kasar. Interest taken on a fresh loan to repay the original loan is eligible because it is still interest on the principal only. Kasak, Karan is asking, sir, if the owner of the house receives some services instead of money as rental, then also it would be taxable. Yes, beta. See, it is not necessary that you should receive income in money form, right? Acha, those who are asking for me the website, it is here. See, you can check the website here. It is incometaxindia.gov.in. This is the parent website. Here you should go. And as you can see, I have created a shortcut. See, here in my Google account, I have created a shortcut. So this helps me to easily refer the act. So you should also create a shortcut in your Google account, right? So this is the website, incometaxindia.gov.in. Fine. Super. Great. So I hope everybody is clear with all the pointers that we have discussed till now. So let me complete the HP part. So we were discussing the computation part. So I'll go back to the cases. The first case is up to 2 self-occupied properties. As we just saw, as per section 23, subsection 2, clause A is you are staying, clause B you cannot stay because you are in some other city. So maybe your parents are staying or it is closed. So it says 24 says you can take the GAV, 23, sorry, says you can take the GAV as nil, and 24 says up to 2 HP you can take it as nil, right? And then all these will be nil. Interest will be allowed as deduction, but this will be only if you're opting for the old regime. That is, you're opting out of the new regime, then only you get this deduction. If you are in the new regime, that is in the default regime, this is not allowed. I have mentioned this here also. So remember this, that this particular point of deduction of up to 2 lakhs or up to 30,000, depending upon whether you have satisfied the condition or not, is applicable for self-occupied HP only if you are in the old regime. If you continue with the new regime, in that case, this deduction will not be allowed. In short, this entire case of self-occupied will be zero. Fine. Second scenario, which is under 23 subsection 4, which we just read, up to any two self-occupied, everything is nil. As we just saw, interest will be as per this, what we just discussed. And beyond two, it will be treated as deemed to be let out. In deemed to be let out, what will happen? GA will be equal to ER. Now municipal tax will be allowed as deduction up to the extent paid. 30% of NAV will be standard deduction. And interest will be allowed irrespective of the limit of 2 lakhs or 30,000. So no limit means whatever interest you have paid, entire interest will be allowed as deduction. Fine, students? Then the third scenario, very simple and plain vanilla case. Your property is let out. Now this may be two or more properties because here no number is important. Whatever number of properties are let out, for all let out properties, this is the answer, which is under 23(1). Your GAV is higher of AR and ER, which we discussed in our first lecture, how to compute this in various case scenarios. Municipal tax paid by the owner will be deducted, NAV, 30% of NAV, and interest will be allowed without limit, right? Now come some very interesting cases. These cases are nowhere expressly given in the law. These are interpretation of whatever 23(1) we studied. What is that? Self-occupied for part of the year. So let us say first 4 months. You are staying in your present house. Then you all shift to a new, bigger house. And for the remaining 8 months, you have let out the property. So such a scenario will fall in this particular case, that your house property is self-occupied for part of the year and then let out for remaining part of the year. In this particular scenario, students, please understand how the GAV will be calculated. You will consider actual rent only for the let out period. So in my example, you will take actual rent of 8 months, which is your let out period. But you will compare it with ER, which is for the whole year. So the ER figure will be taken for 12 months. So this is the only special point in this particular scenario where the property was self-occupied by you for first 4 months, and thereafter you have let out the property for the remaining period, that is 8 months. In such a scenario, GAV will be calculated by taking actual rent of 8 months, but expected rent of entire 12 months. Whatever is higher is GAV. Municipal tax actually paid is deducted. You get NAV. 30% of NAV is your standard deduction. And again, interest, whatever is the amount of interest paid, no limit, no condition of checking when the loan was taken, whether it was taken for purchase construction. So no limit means whatever amount of interest paid is eligible for deduction. Just a minute, students. So is this case scenario clear to everyone? Now, another case scenario is where your property was let out. So you have let out the property, but it remained vacant for the whole year. Why? Because you did not get any customer, any tenant. This is a possibility. Now, if this is the case, then the GAV will be nil. Now here, even though I've written actually paid, practically it would be nil because you cannot deduct anything from a nil GAV. So your annual value will again be nil. Now in this particular case, standard deduction by default will be nil. Now most important, interest will be allowed without any limit. See here, practically everything has come nil, but it is not the case of self-occupied, because in case of self-occupied also everything is nil, but interest has this particular rule of limit in old and zero in new. However, here, since the property is not self-occupied, it is a let-out property. Hence, you get deduction of interest without any qualifying limit. Right? I have some questions. I'll just go through that. Okay, Aniruddha is asking, sir, for a resident and ordinary resident having 4 HPs, self-occupied, 2 of which are outside India, we can take the AV nil for properties outside India also, if their AV is more, and Indian properties as deemed to be let out. Yes, but Aniruddha, we are going to see that in my last slide, that even where the properties are outside India, and because your residential status is ROR, and hence your income even from foreign properties, that is your foreign income is taxable in India because of Section 5, in those cases, whether or not the properties in India are outside, once you are covered under the Indian income tax law, the computation will apply as per our provisions. So in your case, answering your question, you are right. So if your 2 of your properties are outside India, 2 are within India, and you are ROR, that is, even the foreign income is liable to tax, then it is your choice which 2 property you want to take as nil, that is SO. So you can take the 2 foreign properties as SO and Indian properties as DLO, or even vice versa. That depends upon the figures. We make those alternative cases options. Wherever you get the lowest income, you consider that. Harpreet is asking, sir, please explain GAV point in third case. I'm coming to that again, but Harpreet, I think Rachna also has the same question. Sir, is it compare 8 months let out with 12 months ER? Yes, beta, Rachna. So in this case scenario, you will compare the let out rent of 8 months. That is, you will take actual rent of 8 months, compare it with expected rent of 12 months. So there is a very good possibility that ER will be higher and that will become GAV. This is our second case where notional income is getting taxed. So if you remember in my first lecture, we had discussed this, that this is one such head where there are few scenarios where notional income is getting taxed. Scenario 1, where out of AR, ER is higher because the amount of ER is higher. 2, in this case scenario where it is let out for 8 months, but the law says take actual rent of 8 months because you have actual rent only for 8 months, but compare it with ER of 12 months. In this scenario, there is a very good possibility that ER of 12 months would be higher. So this is the second case scenario where notional income is getting taxed under this head. Third case scenario is our case where more than 2 HPs are self-occupied. When more than 2 HPs are self-occupied, in that particular case, up to 2, you take GAV as nil. Beyond 2, you tax the property by taking the GAV as ER. Now, this is the third case scenario where notional income is getting taxed, right? Hardik is asking, sir, in case of deemed resident also, same will be the case now. Deemed resident, but deemed resident is treated as RNOR. And for RNOR, we tax only Indian incomes. Na? For deemed resident, Hardik, deemed resident is further considered as RNOR, right? As per section 6 bracket 1A read with section 6 subsection 2. Now in that particular, 6 subsection 1A read with section 6 subsection 4. Now in that particular case, they are deemed to be resident and they are RNOR. So I don't think whatever Aniruddha said will apply for deemed residents. Sukhveer Kaur, sir, if in case of self-occupied for deduction of interest, it is not stated that 4 conditions are satisfied. But as Sukhveer had mentioned in the previous lecture, where nothing is mentioned about the conditions, you have to assume that the conditions are satisfied and go ahead with the higher limit of 2 lakhs. Sir, in the fifth case, municipal tax is nil. Yes, Kasak beta, municipal tax, I mentioned that I have written over there actual amount, but it will be taken as nil because you cannot deduct municipal tax from a nil GAV. So I mentioned that. So it will be taken as nil. Aniruddha stock in trade, I am coming to that point, beta. Okay. So Harpreet, I think, was asking for third question. Harpreet, beta, in third question, it is a simple case where GAV is higher of AR and ER, which we discussed in the first lecture. So in the third case, there is nothing special. You take GAV as AR or ER, whichever is higher. And then you proceed with the format in the normal manner. Harpreet, I think you had asked me to re-explain third scenario. Preeti is saying once again, sir, once again, what beta? Fine. Okay, now you are saying fourth. See, fourth beta, the point is you are staying in the property for 4 months and you have let out the property for 8 months. Now, in such a case, you are going to find out GAV by taking the actual rent of 4 months. So in this particular case, beta, you have stayed in the property for 4 months. You have rented it out for 8 months. In such a case, even though you are actually staying in the property for 4 months and receiving rent for 8 months, while computing GAV, the actual rent will be of 8 months, but the expected rent that we compute will be taken off 12 months. You'll compare the 8 months actual rent with 12 months expected rent. Whichever is higher will be your GAV. This is fine. Any questions further, beta? Okay, clear. Clear. Yes, sir. Okay, clear. Fine. Perfect. Okay, so if all this is clear, let me go to the last case scenario. See, last case scenario is where your HP partly is let out and partly is self-occupied. I gave the example of this as paying guest, where in the total property, let us say 40% you are using and 60% you have let out. Now, what does the law says? Make two separate workings, assuming there are two different HPs. This 40% will be considered as one HP. This 60% will be considered as another HP. And now in this particular case, for 40%, you do working as case one, that is where the property is self-occupied. For 60% cases, do working as case three, where the property is let out. So for case one, everything will be nil. This will be allowed if you are in the old scheme. If you are in the new scheme, this will be nil. This 60% which is let out, you will do working as per the let out, where GAV will be by taking the rent of 60% property and comparing it with ER of 60%. Municipal tax paid again will be taken for the 60%. You will get NAV 30% will be your deduction. And again in interest, you will take the 60% of the interest. In short, all figures over here will be taken as 60% so that you get the income for the 60% property which is let out. So when there are a scenario of any of these, you have to follow these simple pointers that we just discussed. And according to that, you have to compute the income. Now, besides this, there are some important notes which I have compiled relating to this. So note number one. So see, I'm reading this lower part. If there is any negative income, it is to be adjusted against the other incomes. So we call it as set off. You'll be studying this chapter very soon, that wherever there is a loss, you adjust the loss with other incomes. Now, let us take an example. You have 3 HPs. And these are the three values which you have got where HP2 has a loss. Now, when you will study the set off chapter, you will study that whenever there is a loss, the loss has to be first adjusted under the same head. So if there is a loss in HP2, you'll first try to set it off against the other HP head incomes. And even after adjusting this, let us say still some loss is left. Now this loss, you will try to set it off against the other incomes like salary, like business head, like capital gains, and like other sources except winnings, right? Now, if there is a loss in HP head, the HP loss can be set off against other head incomes except winnings. This is what you all will study under the set off chapter. Now here there is a note relating to this. What it says, that you have to first adjust the loss under same head and then adjust it against income from other heads. This is what I just explained. Now, for HP head, there is a restriction that whenever HP head loss is to be adjusted against other head incomes like here. So this amount of HP loss, which you want to adjust against other incomes, there is a limit of rupees 2 lakhs. So HP loss up to rupees 2 lakhs only can be adjusted against income from other heads. But again, this rule is applicable only if you are following the old tax regime. If you are in the default regime or new regime, then even if there is some loss left out here, even after adjusting from other HP incomes, the balance HP loss will be ignored and you cannot adjust it from other heads. So in the new regime or the default regime, HP loss cannot be adjusted against income from other heads. In the old regime, if you are opting out of the new regime and going to the old regime, then HP head loss can be adjusted from other heads except winnings, but then there is a capping of rupees 2 lakhs. So it can be adjusted against other heads incomes subject to a limit of 2 lakhs. I hope this point is clear to everyone. Manvi saying, sir, in new regime, everything is nil. This is too much of generalization, Manvi. You should not say like this, that everything is nil. Only for self-occupied, this restriction applies. That in new regime, firstly, for self-occupied, you cannot show the interest. The interest deduction for self-occupied will be nil. 1. 2, if there is any loss under any HP, that loss can be adjusted from other HP incomes. But even after adjustment, if there is some loss which is balanced, it cannot be taken outside to be adjusted from other heads income. Correct, Manvi? Yes, Hardik, you are right. Preeti saying, sir, first need to set off with the same head. If not, then need to be set off with other incomes. Yes, beta Preeti, this is the rule. You will study this rule in detail when you are studying the chapter of carry forward and set off of losses. So one more question has come. Manoj is saying, so sir, HP loss can we carry forward for next year? Yes, beta. HP loss as per section 71A. HP loss 71A carry forward section is there, which says that HP loss can be carried forward up to 8 years. And then in those 8 years, in the future, if there is sufficient income, you can add loss. Malu is asking, sir, inadmissible deductions means what? But we are very soon going to discuss PGP. There, this word will be repeated again and again, but still I'm answering. Inadmissible deduction means that expenses which you cannot deduct. Like here, we are saying that this interest cannot be deducted. This up to 2 lakhs or 30,000 interest cannot be deducted if you are in the new scheme. So I will say this 2 lakhs or 30,000 of interest is inadmissible deduction. Inadmissible means it is not allowed, and deduction means to be deducted. So since you cannot deduct this, hence it is called as inadmissible deduction, Malu. Fine. So let out property vacant for whole year looks like as deemed to be let out. No, beta. See, why it is deemed to be let out? It is actually let out. But the only thing is that you did not get a tenant. And if you remember our GAV calculation, we always have the right to deduct vacancy rent. So it is like this, you have taken rent for the whole year, but again, you have deducted it because It is vacancy, and vacancy can be deducted because practically you did not have a tenant in that particular property. Fine, students. Now, let us go to the remaining pointers in this head so that this entire head and the computation will be completed. Now, this was somebody's question, sir, if my property is in foreign country. Now, please pay attention, students. If your property is in foreign country, then there is a very good possibility that the rent is also received there. And if the property and rent both are in foreign, that is the property is also in foreign country or receiving the rent there, then it is called as foreign income. Now it is foreign income. It will be taxable to you only if you are ROR, that is resident and ordinarily resident. Otherwise, it will not be taxable to you. Now, in such a case, where you are ROR and the foreign property is taxable, the question is how the computation will be happening. Now, I answered this when I think somebody has asked me a question relating to this, and there were follow-up questions that when any income, even though foreign income, like in this case, foreign house property, is getting taxed in India because of Section 5 of the Act, because you are ROR, in that particular case, the provisions of our Indian laws will apply. It means all computation, deduction, exemption will be as per our laws and not the foreign laws, because the tax is payable as per the Indian provisions and under the Indian income tax law. So all benefits, all deductions, all computation will be as per the Indian laws only, right? I even answered somebody else's question. Somebody was asking me, sir, what is the relevance of ROR over here? I hope whoever had asked that got the answer. Property is used for business. We already discussed where you are self-occupying the property for your own business. It will not be covered under the head HP because it will be covered under the head PGB. Now, this is a very special case scenario where you are a builder, developer of properties. That is, whatever properties you have, that is appearing as your stock in trade. It means you have constructed the property, but it is not yet sold out. So that property is appearing in your balance sheet as your stock in trade. Now, in this particular case, the law has given a concession. Section 23 bracket 5 says that such a property, which is your stock in trade, will not be taxed for the first 2 years. Now, what they are talking about is, let us say this property is not sold, hence it is your stock in trade, and also this property is not let out. Now, what they are simply trying to say is you will not be liable to pay tax, assuming it to be deemed to be let out. Because we have seen that beyond 2 self-occupied properties, remaining all becomes deemed to be let out. Now, this was a major problem for builders because they may be having multiple properties which are unsold, and they all have kept the property with themselves because they are not giving it on rent because they want to sell it. Now, in such cases, technically, these properties become self-occupied, and for more than 2 self-occupied, all will be deemed to be let out and you end up paying tax on the notional income. Now, these builders were facing a big challenge, so they requested the government, and this particular subsection 5 was introduced few years back, which said that for builders, developers, that is for people for whom this property is appearing as stock in trade, till the time they are not selling it, it will become deemed to be let out because it is self-occupied and more than 2 is deemed to be let out. However, they are given a relaxation for the first 2 years. So initially when the property is ready, the year in which the property becomes ready, that is the completion certificate is received, in short, the property becomes ready. From the end of that year, for next 2 years, the law is ready to wait. It will not treat your property as deemed to be let out. But after 2 years, even if you are not able to sell it after 2 years, it will be considered as deemed to be let out and you will be liable to pay tax. So this provision has given a short-term benefit to the builders that for 2 years, you will not be taxed on those properties. Beyond that, those will be taxed as deemed to be let out, right? Now, for this composite letting, we already discussed in our first lecture where it is inseparable. It may be taxed under PGBP or other sources, the entire rent. And where it is separable, you separate the rent of HP, tax it under that HP, you separate the rent of assets, tax it under other sources. I'm just going through the chat box. There are a few questions. So the first question is by Aniruddha, sir, we need lender certificate for construction or acquisition. Do we need that for repairs also? No, beta. Next is Preeti. Sir, is this reason that it is taxable as the person is ROR? Yes, beta Preeti. So foreign incomes will be taxable to you only if you are ROR. If you are RNOR or NR, foreign incomes will not be taxable to you. For RNOR, only two business foreign incomes are taxed. Other than those two foreign business incomes, no other foreign income is taxed to RNOR. And for NR, no foreign income is taxed. So Preeti, you are right. Sir, of the certificate has been issued at the beginning of the 24-25. So will it be from the end? Yes. In that case, practically you'll get the benefit for 3 years. You are right, Preeti. Sir, in stock and trade case, business let out. No, but if your business is giving property on let out, then the property is not your stock and trade. The property becomes investment. Then this benefit of 2 years will not be applicable. Now, what you are saying, business let out and residential let out, as you said that residential let out is HP and commercial let out is PGBP. Yes, beta. So you're right. If your business is letting out property, firstly, this provision is not for you because that property is not your stock in trade. Be clear. Second thing, what you have said is right. If your business is letting out from this year as per the new budget, if it is residential property, it will be taxed under the head HP by this working. If it is commercial property and your business is letting out, it will be taxed under the PGBP. Hardik is saying, but if RNOR receives the rental income in India, then will it be taxable? But in that particular case, it will become Indian income. So that is why I mentioned over here, two conditions. First, property is also outside and the rent is also received outside, then only it becomes foreign income. If the rent is received in India, then it is no more foreign income, then it becomes Indian income. Sir, income of NR or RNOR, but income received in India. Yes, beta. Same question Hardika has raised, Bhavna. So where the income is received in India, then becomes Indian income. It is no more foreign income then. See, for becoming Indian income, there are two conditions. Either it is received or it is earned. And then it is deemed to be earned or deemed to be received. Any of these conditions, even one happens in India, you call it as Indian income. It is no more foreign. And students? Okay. Now, you can deduct unrealized rent from your actual rent, not from expected rent. This is what we discussed by referring the law also. Now, for deducting unrealized rent from your actual rent, some conditions have to be satisfied. These conditions are covered in Rule 4 and 23.1 had made a reference to this, that if you want to deduct this, the explanation to 23.1 said you have to satisfy the conditions. Now, what are these conditions which you have to satisfy? To get deduction of unrealized rent, 1, the tenancy is bona fide, so it is a genuine case. 2, the tenant who is not paying you rent, you have removed him, or the tenant has left your property. Because if the tenant is still staying in your property, you cannot say it is bad debts. It means you can still recover it. Then you have removed it not only from this property, it is the tenant is not present in any of your property. So it should not happen. Here you have removed, but the tenant is present in some other property. No, the tenant is out of all your properties. And fourth condition is you have taken all reasonable steps for recovery. So whatever actions were supposed to be taken, you have filed a police complaint, you have tried to search for the tenant at all the possible places you know about the tenant, and now you are 100% sure that the tenant has fled. There is no source of connecting to the tenant or finding the traces of the tenant. Then we call it as bad debts and it will be allowed as deduction. So these are the 4 conditions which, if satisfied, you will get deduction of unrealized rent. And then coming to the last part, section 25A. Earlier, there were different sections for arrears of rent and for unrealized rent. Now there is one single section. Now what are we dealing with? Now we are dealing with the future year. So in the current year, let us say unrealized rent happened. So what do you do when there is unrealized rent? You deduct it from AR. This is what we discuss. But in future, after a few years, let us say you catch hold of the tenant or the tenant comes back and you are able to recover this amount. So which amount you are able to recover? The unrealized rent, which was considered by you as bad debts, is now subsequently recovered because you have found the tenant, or the arrears of rent. I'm sure you all now remember arrears. We discussed that. The arrears of rent is in current year, there is a decision made to increase your rent retrospectively of past 2 years or 3 years. And whatever difference of past 2 or 3 years you will receive, that is called as arrears. Now, what is common between both the two? The common point is both these amounts were not taxed in the earlier years. Unrealized rent you had deducted, so it was not taxed. Arrears of rent you did not consider in the income because you are not knowing that there will be any such addition. Now, both these incomes, if realized in a year, the law says it will be taxed in that year as if it is that year's income. So importantly, this is taxed in the year of receipt. Because prior to that, we were not sure whether we will receive this. We are not knowing. So there was no tax on it. So now it will be taxed in the year of receipt. And it will be taxed even if you are not owning that HP. So let us say that HP of which this unrealized rent is or of which this arrears of rent is, now we have already sold off that HP. Still, in the current year, if you are receiving any earlier periods unrealized rent or arrears of rent, it will be taxed. And most importantly, it will be taxed after deducting 30%. So whatever amount of unrealized rent is received or arrears of rent is received, you will deduct 30% for standard deduction. Balance would be taxed. So it is taxable in the year of receipt. 30% deduction has to be deducted. And most important, even if in that year or by that year you have sold the HP, still it is deductible. And then comes the last point of this head, which is under section 26, which is property owned by co-owner, right? Now, in this particular case, where the property is owned by co-owners, what is the rule? So if, firstly, do you understand what is co-ownership? Yes, do you understand what is co-ownership? Anybody? Joint ownership, okay. Simple words, where two or more persons are owning one property. So like somebody said joint owner. So many times we see that you put two or more persons name on the same property because they have collectively purchased that property. This is what is called as co-ownership. Now, what is the special point about co-ownership? About co-ownership, the special point is that where the property is consisting of buildings or buildings and land appertinent thereto is owned by two or more persons and their respective shares are definite. So we already know that you are owning this property jointly. How? 50-50 or let us say 1-4-3-4. In such a case, the simple rule given by this particular section is, the rule is that you will split the HP income between the co-owners. So the rule is where a property is owned by two or more persons jointly, first compute the HP income as what we have done. So whatever we have studied, you compute the HP income according to that particular format. First find out the total HP. Now, after you have found out this total HP income, you will split the HP income in the ratio of ownership. So if the ownership is equal, you will split the income equally. If the ratio is 70-30, you will split the income in the ratio of 70-30, right? So this is what is the simple point. Everything will be, Kasak, you don't have to split the municipal tax or anything. See, first compute the HP income by taking all the figures. So as we have seen, the figures are municipal tax, interest. You take all the figures, compute the HP income first. Now, after doing this, then you will split the final HP. Right, Kasak? Vinuta is saying ownership is the state or fact of legal possession and control of the property, which may be any asset, intangible or tangible. Yes, beta, you're right. Sir, in sub-rental, how to compute? Sub-rental. Mahalakshmi, but I am not getting your question. What is sub-rental? But I did not get your question. Yes, Hardik, you are right. So where you want to take the limit of 2 lakhs, then both the owners will get the entire limit of 2 lakhs because why? We had discussed one word. The limit of 2 lakhs is qua the property, qua the assessee and not qua the property. So let us say here property is one where the assessees are 2. both the assessees will get the limit of 2 lakhs if you are going by the old scheme. Sukhbir is saying, sir, if ownership ratio is not given, then it will not be taxed as per section 26. Then it will be taxed as AOP. So this particular section clearly says that their ratio of ownership is defined. If it is not defined, then in that particular case, you will be taxing it as if it is AOP. Mahalakshmi, if rented person rent to other person, if you remember, it will not be covered in the HP head itself. Right, Mahalakshmi? So Pooja sub-rental means rented property is given on rent. Okay, but beta, then in that case, we are not falling in HP because HP head does not cover subletting. Right? Any further questions, students? Because this is the end of our topic. Sania saying, sir, further letting by tenant, she was asking. See, if tenant is further letting, I have no problem. See, for me as a owner, I am only concerned with the rent which the tenant is paying to. Now, if tenant is paying rent to me and if we are joint owners, so firstly we'll compute income of this HP as per our HP format. And then whatever is the final net income that will be divided between both or a number of owners, whatever they are, in the ratio of ownership. Is this fine, students? Any questions, students? Any further doubts with any of these points? Because this is the end of this head of income. Right? Super. Manvi is asking, sir, what is inadmissible? But a few minutes back, I just said those expenses which you cannot deduct while computing income are called as inadmissible expenses or inadmissible deductions. Right? So inadmissible means what cannot be deducted while computing your income. Understood? Shruti is asking, can you sum up 26? Beta, 26 is very simple. Two or more persons have jointly purchased a property. Now they are getting rent from that property. In that particular case, you first compute HP income of that whole property by our format, what we just studied, GAV minus deduction, NAV minus standard minus interest. Find out the final HP income and then divide the final HP income, Shruti, in the ratio of your ownership. Understood, beta? Sir, PDF share by in BOS in that 0.34 of special point with respect to computation. Gurminder Beda, that old PDF 0.3 and 4 I already covered in the start. That is relating with where I'm in the business of letting out. That is why I removed it from here because it was duplication. Right? Sir, in rule 4, if any one condition is not satisfied, then unrealized rent cannot be deducted. Perfect. Yes, Beda. Yes, Hardik, I know I have raised hand by mistake. I'm trying to find out the option of lowering my hand. Anyways, no problem. So it is me saying hi to everyone. So students, I hope this is very clear to everyone, right? So can we go to the next and the most interesting heads of this syllabus and also the most important one, because every exam, whether inter, whether final, you get you get PGBP question. In fact, many times it is your first compulsory question. Manvi, 30% deduction is applicable in all the cases where your income is covered under HP. So even lease rents are covered under HP as we have seen. Then in that particular case where lease rents are covered in HP, that will also be eligible for 30% deduction. Fine, students? Chalo then. Let me take you to the other topic. Shruti is asking me, sir, I understand the calculation, but you said that 2 lakhs deduction is for both the owners and we do the calculation of tax beforehand and do the proportion. See, beta Shruti, if the property is self-occupied, then as you remember, Shruti, in that particular case, we directly take the interest only as the final loss, right? Now, in that particular case, where the interest is your final loss, we have seen that normally the rule is that you will be taking the loss up to maximum 2 lakhs, assuming all conditions are satisfied, right? Now, that is where this particular points come into picture, where it says that where you are co-ownership, in that particular case, the 2 lakhs will be decided after you have distributed the loss. So you first compute the total loss without taking the 2 lakhs limit, Shruti. You will divide the loss in the ratio. Let us say 7330 is the ratio. Now you apply the limit of 2 lakhs because the 2 lakhs limit is qua the assessee and not qua the property. Fine, Shruti Beda? I hope I could answer you. Great. Fine. So students, let us now go to the next and the most important head of income for exams, both interfinal and most importantly for your entire profession, especially when you are in practice. Now, what is this business head? As the name suggests, what we are going to cover under this head is income arising from business or profession. Now, before I go to the definition of business profession, that is the theory part, I'll take that a bit later. My interest is more in the computation part. And for explaining you the computation, let me show you how you get the question. So generally, the question that you will get, students, will be like a trading P&L account format. So in the question, they would be giving you a trading P&L account format, which I'm sure everybody has seen. And from this format, you will be asked to compute the income. Now see, generally, they ask you to compute entire, means total income, not only PGBP, income from other sources, income from salary, whatever. That is what is the comprehensive sum, which is also your compulsory question. So first is on this chapter, what you are expecting in the exams is the comprehensive sum. So generally, in that sum, not only PGBP, you will be computing income from every head. Second, you can only expect a PGBP question also, that is from the same data. They will ask you to compute only income under the head business. Thirdly, from this chapter, you may get a sum on any individual section like depreciation, like scientific research that we are going to study in further lectures. So in this particular head, you can expect question not on the entire PGBP, but also on one single section where that single section has some important computation. Like as I gave you example, it may be computation of depreciation under income tax or any such thing. And fourthly, this chapter is also important for case study questions because generally case study questions, as you know, is a comprehensive question again. It covers question from different chapters and you can very well expect one of the case study MCQ to be based on PGBP. So this is the relevance of PGBP in exams. And at finals, you will find that you are required to do computation of company, of partnership firm, of trust, of different entities. In all entities, the major source is generally PGBP only. So keep this in mind. This is the importance of this chapter. Now, after giving you the importance of this chapter, let me explain you with the practical first. We'll take the practicals and from practical we'll come to theory so that you will find more connection, more interest in understanding that particular topic, right? Now, generally, as you can see on the screen, will be given a profit and loss, something like this only profit and loss we have seen. But here, this is a more detailed profit and loss because I want to give you the overview of the entire business head. Now, students, right from standard 11 in commerce, you all have been trained to prepare the profit and loss account, which also gives you your net profit. See, so your profit and loss account is also giving you net profit, which is, you can say, as good as the total income under income tax law. You can say so. though the amounts will never be same because both the laws, one is the income tax law and the other is the accounting standards, have different principles. But at least at conceptual level, this net profit that you are getting in your trading P&L account is similar to the final total income that we get in income tax. Now, the point is the difference between accounts and income taxes. Accounts follows entity concept, whereby you prepare the financial books for each entity separately, point number one, and then for each entity, you compute the total income. In income tax, we have the similar concept where we call the person as assessee. So over here in accounts, you call it as entity. In income tax, you call it as assessee. So it is the only difference of terminology. But the biggest difference is when you see a trading P&L account like this, you do not segregate your accounting data head-wise. The concept of heads is only present in income tax, not even in the subject of GST. In GST also, on all these credit side items, majority of these items would be liable to GST, some may be exempt. But over there also, you don't have such heads like business head or HP head or other sources head. GST is on all items by simply classifying it, whether it is supply of goods or supply of service, that's it. However, when you come to income tax, the difference between accounts and income tax is the same thing, the same net profit, which is total income over here, will not be computed like your P&L by putting all incomes and expenses at one place. You segregate it and compute it headwise into salary, house property, PGBP, that is the business head, capital gains, and other sources. So the most important difference to be noted is accounts goes by the entity concept, where you find out the total income loss of the whole entity as one. Whereas PGBP goes, or the income tax laws goes headwise. Now, to compute your PGBP income, in all questions, you are given the accounting data, where generally the starting point is always your accounting net profit. So you are given the accounting net profit, which you have derived by taking all these things on the credit side and all these things on the debit side. So obviously, mathematically, the debit side items have been deducted from the credit side items, and you have got this amount, which is your net balance. Now, this particular amount, which is derived from your accounts, from this, you have to find out your total income as per the income tax. Now, how this is done? This is done by our very well known and favorite concept of reconciliation, as you can see here. So we find out our PGBP income by doing reconciliation, where the starting point is your net profit as per accounting provisions. In that, we add certain items, we deduct certain items, so we finally land at our PGBP. So please understand and appreciate the logic of this format. So the logic of this format is, in your exams, as I said, all your PGBP questions, or for that matter, even the comprehensive sums where you have to compute the total income, not only PGBP, they always start with the accounting data, where either they will give you the total trading P&L account like this, or they will give you the data about accounting, but they will say that the net profit shown by your accounts is this much. And from this net profit, and with some other adjustments and data given, they ask you to compute your final income, which may be the total income or which may be PGBP. Here, we are going to limit our discussions to finding out PGBP income from the accounting P&L. How total income is to be computed, the process is same. What process we are going to study, the process is same. The only thing is that you will segregate each income under respective heads and you'll apply the format of each head separately. So you'll get your total income. Here in this chapter, we will limit our discussion only to the PGBP income. So first understand this point. You are given the net profit of accounts, and from that accounting net profit, you have to compute the total income under the income tax. Now, what are these steps? There are broadly two steps. Step one is I call this step as segregation. What is segregation is, as you have seen, your accounting P&L has everything put at one place. There is no bifurcation of head. Now, if I want to find out my PGBP income, what I need to do is I need to segregate, which means that from the credit side of my P&L, I have to identify those items, those incomes which belong to any other head like house property, etc., etc. So out of all the credit items, I have to tick and identify those items which are not part of business head. Similarly, applying the matching principle, now I go to the debit side of my P&L and applying the matching principle, I will find out again those items on the debit side which again belong to some other heads, which may be HP, salary, whatever, but it is not PGBP head. So my first step is identifying those items which belong to other heads. Now here you will find that I have taken a comprehensive P&L where I have tried to project all possible revenues and incomes that are there in a P&L. And now I have given sections whereby this section 28 and this section 41. These are the sections which deals with the business head items. Other than this, whatever other credit items you can see on your screen, they all are not belonging to the business head. They may be house property, other sources, capital, whatever. That is not my concern right now. Now, please understand one thing. Now, this is the most important point, students. Our starting point given in the sum is your net profit as per accounts. And please understand, this net profit as per accounts is including all these credit items which are not part of business head. Now, if I want to ensure that I want or I get only PGBP income, I will have to adjust the effect of all these amounts from the net profit so that from this net profit, I derive my business income. I repeat, this net profit, as you can see, is made up of all items. This net profit is made up of all items which are there in the trading P&L account on the debit side and on the credit side. Now, out of these, in my first step, I have identified those items which are not pertaining to business. So they are all these items. Now, this net profit has the effect of all these amounts. So I need to adjust the net profit for these amounts. Now, when I say I need to adjust the net profit, as I have already shown you, we follow the reconciliation format where by starting from the P&L, we will reach the PGBP amount. Now, my question is, I am given this net profit, let us say 28 lakhs 40,000 in the sum. And all these different items and their respective amounts are given in the P&L or in the adjustment. Now my question is, while preparing the reconciliation, what will I do of these items? Whether I will add it to the net profit or whether I will reduce it. If you want to say add, you can write A. If you want to say reduce, you'll write R. So whether I will add all the credit items or I will reduce all the credit items while finding out PGBP income. Excellent. Manvi, you are saying add, but it is reduce. Others, Hardik, Pooja, Shruti, Priti, Abhishek, Kasap, Pranav, Kambeshwari, Vaidahi, Anjali, Riddhi, Noruddin, Rachna, Harpreet, Jinki, Ratimalani, Sukhveer. No, Jinki, you are saying add. That is not correct, beta. Yes. Super. So 98% of y'all are saying reduce. Now, for those who are saying add, please, I follow this method. This is my PGBP income. That is profit as per the PGBP head. This is my net profit as per accounts. Now, all these items which you can see over here on the credit side, I want to find out what impact this has created on my which income? On my accounting income. So for all these credit items, the impact on my accounting income is my accounting income has gone up. So my net profit as per accounts is higher because of these items, because these are credit items. Now, in my reconciliation format, we start with the net profit of accounts and we have to reach the PGBP income. So what I have to do is I have to reduce it. So that is why from my net profit as per accounts, I will reduce all those items which are on the credit side of the profit and loss account, but which are not taxable under the head business. I hope this is clear and understood by all. That these amounts have to be reduced because we are starting from the accounting profit level, and accounting profit has been increased because these items are credit items. And you can understand this very simply that because of credit, the profit increases. Now, if I want to find out my PGBP income, I will have to remove the effect of these items by reducing this from the accounting net profit. I hope this is clear and understood by all. Yes, students, is this clear to all? Right? Now, similarly, applying the matching principle on the debit side also, many times you write such items like loss on sale of asset or investment. This is a capital gain head item. Similarly, you may have items like interest, items like taxes. So let us say you have taxes, repairs, depreciation, you may have interest. Now, all these expenses are pertaining to, let us say, the HP, which has been let out, for which the rent is covered under the head HP. Now, if for this HP, you have paid property tax, you have done repairs, there is depreciation of this HP, and you have taken loan. Now, applying the matching principle, if the income of that particular head is not falling under PGBP, then obviously the expenses also will not be covered under PGBP. But again, as per our accounting entity principle, we have debited all that, and it is again having some effect in this net profit of 28,40,000. What is the effect? See, again, same. So these expenses have been debited in your profit and loss account. Now, because they have been debited in your profit and loss account, the effect of that is that the profit has been reduced. Which profit is reduced? The accounting profit. Now, in order that you reach from accounting profit to PGBP head, you will have to go upwards. So what you have to do is all these expenses which are debited to P&L, but which pertain to some other heads, you will have to add it back to the profit. So in the reconciliation format, these credit items which are of other heads will be reduced from the net profit, and these debit items which are again pertaining to other heads have to be added. Did you understand this first part? Add and less of the non-PGBP items which are finding place in your profit and loss. And always remember this, see, follow this rule. So one hand is your accounting net profit, one hand is your PGBP. Just see what is the impact of that item on your profits. And remember, in this, our starting point is always accounting net profit. From there, if you have to come down to PGBP, you will less. If from there you have to go upwards towards the PGBP, you will add. Now, this is my adjustment or step number 1. Now, in step number 1, what you have done, you have got rid of all the non-PGBP items from the debit and credit side both, right? But this is not sufficient. Now, after removing these, technically now you are left with only PGBP, or I'll use the word business incomes and business expenses, correct? But it is not necessary that whatever you are left with, even though they are pertaining to business only, the entire income and entire expense is finding place in PGBP. Not necessary. Here you apply step 2. What is step 2? Now you go to the PGBP head, you read the PGBP provisions to find out that for these remaining items which are now pertaining to business, can you consider these items under the head PGBP? Now somebody will say, sir, these are business items only because we have removed all other items. So what is now left is business item only. Then the question is, why are you talking about this? Ki we have to check whether these are covered under business or not. Because understand students, this accounting P&L is prepared as per accounting principles, which are mentioned in your accounting standards. There are different accounting conventions. There are different accounting assumptions. All of that make up the subject of accounts. Now, it is not necessary that what accounts say or what is the principle or the logic of accounts, the same would apply to the business head as well. Because PGBP or the business head is altogether a separate law, which is the income tax law. Income tax law, as you can see in this sheet itself, I put the section numbers against each item. So the business law itself has separate sections for each item, and each section has put some conditions, some restrictions, some amount limit, because of which, even though that item of income or expense may be pertaining to business, but it may not find place in the head PGBP 1, or it is covered in PGBP but at a different amount. So accounts is saying 100, let us say depreciation, accounts is showing 100 rupees depreciation, PGBP working says 120. So depreciation is there in both, but the amount may be different. So there is a possibility that when you are dealing with the business head, even though it is a business item, still the amounts may be different. Is this clear to all? Any questions? Yes, students, is this clear to all? I hope you have understood why there would be a difference and what is the need for doing this reconciliation. Also, I hope you all understand the reconciliation format. Let me take up your questions. Preeti is asking, sir, will it always be starting point as accounting net profit? Yes, beta. Because PGBP you have to find out. You don't have to find out accounts. PGBP you will find out. And the data that is always given in the sum is of accounts. So by default in this chapter, the starting point will always be accounts. Right, beta? Now, students, I'll explain you this format first so that you'll understand and appreciate what does the format stays. Kassak is saying, sir, instead to adjustments for items for PGBP wrongly charged. Okay, see, I cannot say it is wrong, beta, because accounts has a different logic and income tax has a different logic. So as per accounts, it is right. But now since you are going from accounts to PGBP, PGBP logic may be different. So now when you apply the PGBP logic, it will be different, or the amount that you are getting will always be different, right? By this saying, sir, income from house property is related with house property, then income tax in profit and loss will be deducted. Very sorry, I did not get your question. Yes, Hardik, it is similar to what we studied in costing also, relating to reconciliation of income tax, accounting profit with the cost sheet profit. Tambeshwari, this PPT I am yet to share. Don't worry. I'll share this towards the end. I'm intentionally not sharing it because this PPT is in a very short version. If I share it at the start, you will not study the module. This is what I don't want. I want my students to study module completely. I want my students to study the Bare Act completely. Students, this PPT will give you everything in the most concise form relevant to your exams. I am 100% sharing this, but not immediately. I'll be right now here. Today I uploaded one PPT immediately before the class that was relating to two basic practical questions. And further also, till this class is concluded, I will be sharing only the practice sums PDF or PPT. But definitely this PDF I will be sharing. This will be a short handbook to you for understanding PGBP quickly. But I don't want this quickness to happen at the start because you are just starting with this beautiful chapter and also the most important subject of your career, I will say. Because as I said, if you are in practice, 90% of your clients relevance in your exams at both the levels. So let us understand it in detail. Don't worry for the PDF, everything will be shared with you. Okay, students. Now, let me explain you the format. And remember one thing, wherever you are stuck, use this rule. So one is your accounting net profit. This is your business or PGBP income. See, I'm not talking about total income. I'm talking about only business head. So we have to check what is the impact of a particular item on these profits. So first find out level, who is standing where. And remember your starting point is always your which head? The starting point is always your accounting. So you start from accounting. If your business income is standing at a lower level, you have to climb down, you will reduce. If your business income is standing at a higher level, you have to climb up, you will add. Preeti, accounting NP. Net profit. Yes, but starting point is accounting net profit always. Right. Now, what are the add items? Add items are items debited to P&L, but which are not allowed as deduction under PGBP. So few people were using this word. You can say inadmissible deductions. So there are some expenses which cannot be deducted in PGBP. Reason one, either they are not business head items, they are pertaining to other heads, or two, they may be business head items, but as per the PGBP provisions, they are not finding place in PGBP, or they are finding place in PGBP, but with different amounts. So like, as I give you example of depreciation, depreciation is there in accounts also, and even income tax allows to deduct depreciation as an expense, but the amount is always different. So simple, look at this. So this is what? This is accounts, this is PGBP. Now you have debited something in accounts. So because of this, accounting profit is less. The same thing do not find place in PGBP because it is not allowed as deduction in PGBP, it is inadmissible. So wherever you have debited something in accounts, your accounting net profit has reduced. So what you have to do is you have to climb upwards. So what you are going to do is you are going to add. Same example, let us say depreciation. Depreciation is finding place in both cases. In accounts, the depreciation is rupees 200. So accounting profit is less by 200. In income tax, it is only 120. So income tax profit is also less but by only 120. See, I repeat. So accounting profit is less by 200. Income tax profit is less by 120. So there is a difference of 80. So what you will do for this 80, you have to climb upwards. Why? Because the accounting profit is reduced by 200 because it is debit by 200. The PGBP is reduced by 120 because only 120 is allowed as deduction in PGBP. So for this difference 80, you will add. It may be the other way around also, right? Where the figures are opposite. So first thing that you will add in accounting net profit is items which are debited in profit and loss account, but which are not allowed as deduction in PGBP, either completely or partly, right? Similarly, the next item which is add is items which are not credited to P&L, but which are taxable as income under PGBP. So there is some item of income which is taxable under the head PGBP. Now see, if it is taxable under the head PGBP, it means PGBP profit is higher because it is taxable under the head PGBP. But accounts has not credited it, so account is standing here. So it is income under PGBP, so PGBP profit has to be higher. But accounts has not credited it, so account is standing here only. Now for this item also, at the time of reconciliation, you'll have to climb upwards. So what you will do is you will add. Now this is a very rare adjustment. The red ones are the most common adjustment. That is why I put it in red. But the other ones are also important, but rarely you find one or two adjustments on this. So the second item of add is those items of income which are taxable in PGBP, but sorry, which are taxable in PGBP, but your accounts has not shown it in the credit for some reason. So you have to climb upwards. It will be added. Now coming to less, again items on the credit side of P&L. So certain incomes are credited to P&L, but these incomes do not find place under PGBP. Why? Because they are not business items. They are other sources, head or HP or capital, any other head income. So in such a case, again, what is happening? These items are credited to accounting P&L, because of which accounting profit has increased, because they are credited here. PGBP does not cover it, so PGP stays here. Now, in order to reconcile, you have to climb downwards, so it will be less. Another less item is, there may be some item of expenditure which is not debited to P&L. So account has not debited it, but income tax says, Arey Baba, we allow deduction of this expense. So there is some amount which income tax allows as deduction, but accounting has not debited it because it is not fitting in the accounting principle. So see, again, what has happened? Your PGBP allows the deduction. It means in PGBP, it is an expense. So PGP will reduce because that is an expense in PGP, but it is not shown in accounting P&L. So accounting P&L stands here. But PGBP is reduced. Why? Because it is an expense in PGBP. So to match, you have to climb down. So one is either the amount of expense is only in PGBP, not in accounts. Second reason of this could be it is there in both, but the amounts are different, like depreciation. In PGBP, the amount of depreciation is 120. So PGBP profit is reduced by 120. In accounts, the depreciation is of only rupees 100. So accounts is also reduced by rupees 100. PGBP is reduced by 120. Accounts is reduced by 100. So there is a difference of 20. Again, you have to deduct it. So please understand, students, this reconciliation is simple to understand. You have to simply understand what is the impact of that item on the business profits, what is the impact of that item on the accounting profits, find the correct levels, and always the starting point is accounting P&L. Is this clear to all? Students, anybody having any doubts, any questions, please feel free to ask. Okay. 2 people have responded that they have understood. Anybody else has any doubts? Please feel free to ask. No doubt, students. Pakka? Okay, fine. Should we proceed then? Okay, so others are also responding. So understood. Right, right, Hardik. Pranav, Niru, Abhishek, Rachna, Pooja, Sukhveer, Dilip, Tambeshwari, Vinutha, Bhumika, Hardik, Vinutha, Malu. Great. Pratimalan. Excellent. Fine. So, with your permission, let me proceed. Now I'll explain you these steps. So step 1, we already saw by identifying the items. Now this you identify as per the names. You will tick those items which are not part of business head. If they are on the credit side of P&L, you have to reduce it in the reconciliation. If they are on the debit side of the P&L, you have to add it in the reconciliation. Now the second step is interesting. What is the second step? Second step is applying PGBP provisions. What it means, you have to check the PGBP provisions for the income side and for the expense side. And for both these sides, you have to find out what does the PGBP provision says. Now I'll take you to the income side first. There are three sections which deals with the income side of PGBP, which tells you as to what items would be considered as income and to what extent under PGBP. Let me explain you that, and then we'll go to the expense side. So section 28. See, theoretically, you can read section 28 from your module from the Act. Practically what it is, I'll explain. 28 basically deals with all types of receipts of business. So when you're doing business, whatever receipts you get from business. Now, what are these business receipts? These are in the form of sales. If you are in profession, it will be in the form of fees, charges. If you are in the business of transport, it will be in the form of freight, hire. If you are in the business of giving on rent, it would be rent, it would be lease. Obviously, renting of residential, even though it is a business, is now part of HP, that I'm sure you all will recall. So depending upon the nature of your business, these receipts names would vary. And then you have the sundry or the miscellaneous. See, if this is given in the sum and they have not defined what is sundry or miscellaneous, you have to presume it is some sundry income relating to your business only, right? Now, these are all business receipts. Other than these, other items like rent of house property, interest, dividend, then maybe profit on sale of asset or investment, then life insurance matured. All these are non-business items. They will not find place in section 28 because section 28 says it covers mainly only business receipts. So whatever is the nature of your business, like you are in agency business, so even commission or brokerage. So these are all business receipts depending upon the nature of business. These all are covered as per section 28 under the head PGBP. I hope this is clear to all. Now comes something interesting. Section 41. The second item which is covered in PGBP as an income is what? Now, the second item which is covered in PGBP as an income, which section 41 covers, is what? It covers those expenses or losses of earlier years which are recovered or reimbursed. So 41 covers recovery or reimbursement of what? Expenses of losses of earlier years. Now somebody will say, sir, what is the example? Simplest example is bad debts recovered. Tax refunds. Insurance claim of loss by fire. Now all these are examples of what? These are expenses or losses of some earlier years, but in the current year you have received or got reimbursement. So these are recovered by you. These are reimbursed to you. Then they find place in section 41, but with a very important condition. What is this important condition? The important condition is if these were allowed as deduction in PGBP. Now this is interesting. It is simple, nothing technical, nothing difficult. See, what is the point? We are saying that these are expenses or losses of past periods, like bad debts. Now in the current period, you have recovered it, fine. But in the current period, in order that they are treated as income, the first basic requirement to be checked is, in the past period when these expenses or losses occurred, did you get the deduction of these expenses in PGBP? So when we are checking the debit side of PGBP, we check whether that expense is allowed by the PGBP head, that is whether it is a deductible item or not. If it is a deductible item, we say that the deduction was allowed. It was admissible deduction. It was allowed as deduction. Now, if such an item is there, which was allowed as deduction in the past, that item got recovered, reimbursed to you in the current period. So we consider it as income in PGBP. But if this item was not allowed as deduction in the past, so in the past when this happened, this loss happened, you did not get deduction of that item. In that case, in the current year, even though it is recovered, received by you, we will not treat it as your income. I hope this is clear. The simple example or logic, not example, logic is, so this is my P&L. See, even in accounts, what you do? In past, we have shown bad debts, which is a debit item. So you have shown it as bad debts. It means you have shown it as a deduction from profits. Now in future, this bad debts, which was shown as debit, gets recovered, gets reimbursed to you. You get the trace or catch hold of that data and you recover amount from that data. Then you show it on the credit side as bad debts recovered. But this you can credit in accounts only if in the past you had debited this expense. If in the past, for some reason, this was not debited in your P&L, then it will not even be credited in the P&L when this amount is recovered. This is the law of accounts also. So what we are saying over here in section 41 is nothing great. It is what is the logic of accounts also, that item which was debited in past as a loss or as an expense, if it is reimbursed to you, then only it is shown as a credit. If in the past it was not debit, in the current year, it will not be credit also. So basically, when you are showing it as a credit in the current year, what you are doing in the current year is simply nullifying the past year's debit effect. So for nullifying the debit effect, you are showing it as a credit. Remember this. So since it was shown as a debit earlier, now you are showing it as a credit. Had it not been debited earlier, now it will not even be credited. This is the simple logic. I hope this is clear to everyone. Right, students? Is this fine? Yes, students, I hope what I explained to you was clear. Now, when you get any type of item on the credit side which says income tax refunded or bad debts recovered or any loss recovered, fine, it is on the credit side of P&L. Now we have to check whether it will be treated as income in PGBP or not. For that, you have to apply this rule that this item, which is actually your loss or expense, does income tax allow it under the head PGBP as deduction? If the income tax allows it under the PGBP as deduction, then only today it will be treated as an income under PGBP. If PGBP was not allowing this as deduction in the past, in the current year, even though this amount is received, recovered, income tax will not treat it as income under PGBP. Preeti, you're right. So if it is debited, then it will be credited here. Yes. Perfect, Preeti. So I hope this 41 logic is clear to everyone. So basically 41 will cover all these items. Bad debts recovered, any type of tax refunds, any type of insurance claims. But see, these are all credited to P&L in the sum. Now you have to check whether this will be part of PGBP income or not. And how you will check? You have to check whether bad debts is allowed as deduction when it is shown on debit side. Whether that tax when it is paid is allowed as deduction on the debit side. Whether that insurance claim whenever the loss has happened, whether that loss is shown as a debit item in PGBP. If your answer is yes, that bad debts, that loss, that tax is shown as a debit item in PGBP, that is, it is allowed as deduction, then you will go ahead to treat it as income in PGBP. But if your answer is no, this item is not allowed as deduction in PGBP, then you will not even show it as income in PGBP. I hope this point is clear. This is what is the crucial point about section 41. Sorry, Hardik, I did not get your question, madam. We will give deduction of it. I did not get this point. Yes,
Good,
Hardik.
good evening, sir.
Good evening, madam. Tell me.
Sir, I was asking that you have said that tax refunds are allowed as a deduction.
No,
So,
I did not say are allowed. I said if allowed, then their refund would be tax. We will have to check whether the tax refund are allowed as deduction. That we will check when we study the debit side provisions.
okay, sir. Sir, my doubt was in relation to that. Will in income tax we will give a deduction of income tax?
Let me give you answer. Income tax is not allowed as deduction under PGBP.
Yes, sir. That's what I was asking.
Yes. But
Okay.
GST is, customs duty is. So that is why I said we'll have to check whether that tax when paid is allowed as deduction or not. If it is allowed as deduction, then it is income. If not allowed, not income.
Okay, sir.
Rati Malani, I'll just correct you. You said whatever is allowed in 41 will be treated as income in PGP. It is not allowed in 41, beta. 41 is the income section. It is allowed as deduction in the sections from 30 to 38. See, my P&L. These are the sections 37, 30, 32, 31, 35, etc., etc., which are the sections for allowing deduction. So these sections allow you deduction. And if your amount of expense or loss which is recovered today was allowed as deduction under any of these sections earlier, then today under 41, it will be considered as income. So 41 is a section of income, Ratimalan, right? Bad debts is not received. Malu, see beta, bad debts is first incurred. That is some person, some debtor is now not paying you and the debtor has gone bad. So you write off bad debts, that is you consider that debtor as a loss. So first bad debts is incurred means the debtor has gone bad, the debtor is not paying you anything, you consider the debtor as loss. Now, till that debtor is not paying, no effect is done because you have already shown the debtor as loss. Now in future, if you catch the debtor and you are able to recover any amount from the debtor, then we say that the debtor, the bad debts is recovered and then you treat it as income under section 41, subsection 4. Riddhi is asking in PGP have any deduction? Arey beta, PGBP has a big list of deductions. See my debit side. See the sections 37, 30, 30, 32, 35. There are minimum 50 deduction sections in PGBP. Don't worry, PGBP is going to be fun. But we will approach PGBP from my side, that is from this PDF. And then we will go to your module. So first two sessions today and the next one, we will study only from my PDF so that you'll understand the whole PGBP in a very lucid way. But a VRS is voluntary retirement scheme. So where you are asking some employee to leave before his employment period or his what you say, not maturity, what retirement day age has come. If you ask the employee to leave, then you have to pay a lump sum compensation. That is what is VRS compensation, which is an expense for the employer because he has to pay to the employee, right? Okay. So see, these are the three sections. 28 are the receipts from business. 41 is the recovery of your past expenses or losses. Now, what is this 43CA? 43CA is interesting. I'll write it here. Actually, it is already here in notes, but I'll write it here for your understanding. Now, what is this 43CA dealing with? 43CA deals with builders who have land or building as their stock in trade. So you are a dealer of land building. Yes, Bhavna. VRS is related to salary chapter. In salary, it is your income as salary because you are employee. In PGBP, it is my expense as employer. So it is covered in both chapters. In PGP, it is from the employer side, so it is expense. In salary, it is from the employee side, so it is income. Right, beta? Pooja, for example, if earlier bad debts is 2 lakh and allowed only 40. Pooja, let us take your example a bit later. But what you're saying is right. If out of 2 lakhs, only 40 was allowed as deduction. And if any part is recovered, then the treatment is we will assume that part is recovered out of the not allowed part. So in your example, 40,000 will not be my income will be zero. Because out of 2 lakhs, 160 was not allowed as deduction in your example. Only 40 was allowed. So if anything is recovered, I will assume I'm recovering out of the not allowed portion, that is out of the 160 first. And until unless that entire 160 is recovered, nothing would be taxed. Pooja, so this is the answer, though it was a very, what you say, the advanced level question. So I just hope you understood the answer. But Nitin, CRS means corporate social responsibility expenses. These expenses have to be incurred by company. See, please, students, don't go by the detailings of the expense. You'll study everything. They are just given for your overall understanding purpose of the subject. Don't go by the detailings of the expense now, that we'll study in each section in detail. As I said, there are 50 plus sections only for deductions and expenses. Now pay attention. 43CA, the third section relating to income side of PGBP is applicable to builders. Now for builders, land or building is a stock in trade. That is, they are keeping this as a stock in trade because their business is to sell it and earn income. Now, let us say they have sold this for rupees 2 crore. So the builder has sold one of the flats for rupees 2 crores. Now in accounts, on the credit side here, the sales shown by the builder will be rupees 2 crores. Correct? Nothing wrong. But income tax says, fine, 2 crores value we will check as per 43CA. So firstly, as per 28, for me, this particular sale of flat is a PGBP receipt because you are in the business of selling flats. So as per 28, it is a business receipt, no problem. But only for builders, there is this section applicable 43CA which says, wait, I will not accept your value of 2 crores. We will find value as per 43CA. Now, what does 43CA says? 43CA says, see, this is your agreement value or your sale value as per your agreement. So this is 2 CR. Now, 43CA says, since it is an immovable property, there is another value of immovable property which is called as the stamp value. They will say, find out what is the stamp value. First possibility, stamp value is 1.9 CR. It means the stamp value is lower than your agreement value. Correct? Now, 43CA says, what we will consider it as your sale value for PGBP income? 2 CR. That is the agreement value. Second possibility, your stamp value is 2.1 CR. And third possibility, your stamp value is 2.25 CR. So these are the three possible stamp values. First case, stamp value is 1.9 CR. They say, 43CA says, we will take 2 CR only as your PGBP sales. If your stamp value is higher, like in my second and third case, if your stamp value is higher, they will say, wait, I will not directly take your stamp value as PGBP sales. We will add a 10% to your agreement value. Now, if I add 10%, how much it becomes? Now, if this 2.2 CR, that is after adding 10%, is greater than your stamp value, then again, your agreement value is your PGBP sales. So in first two scenarios, as per 43CA, PGBP will also show sales of 2 CR, which is also shown by accounts. I hope this is clear. No doubts. However, where stamp value is 2.25 CR and it is still greater than this 2.2 CR, which is after adding the 10%. In this case, where the stamp value is more than 10% of your agreement value, in that case, they will say now your sale value as per PGBP will be this. Now PGBP will say, okay, you may have shown 2 crores. I will consider your sale value for PGBP purpose as 2.25 CR. I repeat this point because I'm sure it may be slightly troubling because it is something new, it is something different. So firstly, what is stamp value? See, whenever you are dealing in immobile properties like land or building, that is a constructed thing or a land, then whenever you buy, sell these properties, you have to get them registered with the state government, with the registrar office, and the registrar people have their own value of every property on which they compute the stamp duty. That value is called as the stamp value. So the value which is used by the registrar for computing their stamp duty is what is called as stamp value. Now, for every property, be it land or any constructed, whether house or shop or office or godown, for every immovable property, the registrar of every place has a value. Some people call it as the stamp value. Some people call it as the circle rate, anything. But law in income tax, they have used the word stamp value. So I'm using the stamp value. So it is the value which is fixed for calculating the stamp duty. Correct? Now, what does 43A says? It says that firstly, 43CA applies only to builders. That is for whom this land or building is a stock in trade. That is their intention is to sell and earn. That is their business. Now, whenever they are selling this, so firstly, it is a PGBP sale because it is stock in trade. So as per 28, we will consider this as your PGBP sales, not a problem. The problem is only about the valuation, which is taken care of by 43C. 43A says there are three possibilities. Possibility one, your agreement value is higher than the stamp value. Now, since your agreement value is higher, agreement value is your PGBP sales. Fine. However, where stamp duty is higher, stamp duty value is higher, they say, okay, do one thing in your agreement value, add 10%. Now, when you add 10% to your agreement value, you get a new value. This value is used only for comparison. Now, this value is 2.2 CR. Compare this value with the stamp value. Now, in my second example, stamp value is 2.1 CR, whereas this new value is 2.2 CR, which is higher than stamp value. In that case, again, the answer is the sale value for PGBP will still be your agreement value. Third possibility, your stamp value is 2.25 CR, which is now greater than this 2.2 CR. So in simple words, where stamp value is greater than 110% of agreement value, in that case, stamp value will be considered as PGBP sales. That is the point. Why add 10%, Bhavna? Because 10% is the margin of difference allowed by the law. See over here, if you can see this sheet, I've also written 120% and then I've put a crossbar. Why? Originally, the law had also allowed up to 20% difference. Later on, they reduced it and made it 110. So basically, the point is up to 10% variation is allowed. Now, see, this is logical also because stamp value is an artificial value and agreement value is the actual sale value. See, basically, this particular logic is people were resorting to tax evasion by showing lower values of property transactions. So see, they want to register the property because that is law, but they do not want to pay stamp duty. They do not want to pay income tax. So they purposefully were showing lower values. So to get over this practice, the stamp value concept was introduced, whereby now even if you are showing lower agreement value, we will show the stamp value, which according to the government is the correct price of that property. So the government is not losing on tax, right? And the same logic, then income tax also applied that, okay, then we can also use this stamp value for computing our PGBP income. So they brought this concept here, but taking the stamp value as it is may not be very correct because stamp value is ultimately an artificial value. So they say, no problem, we allow 10% margin. That even if your agreement value is less than stamp value, but the margin or the difference is not more than 10%, still your agreement value is accepted because that much margin we are okay. But where the difference between the stamp value and agreement value is beyond 10%. So stamp value is much, much higher than your agreement value. Then we consider that you are doing some jol, some adjustment in your agreement value. This is what we are assuming. And hence we consider stamp value as your PGBP sales. I hope this is clear. 43C. See, this point will be only useful to you in case studies because practical questions on PGBP generally will not be covering builder case. At least I haven't seen a sum till now, but yes, in your case study where you have one MCQ question, this will be helpful. And whatever I've just explained, the same type of example is covered. They will give you these values and they will ask you to tick from the MCQ ABC option, which value is correct, which value will be PGP sales. See, stamp value, beta Hardik, is fixed by the government, but obviously with inflation, with change in market conditions, government also keeps on revising, but it is not change every day because it is fixed. Fixed means the government has to put it on record. It is printed everywhere with all the registrar offices. So even though it changes over a period of time, maybe in 6 months or in a year. So for that period, it is generally kept fixed by the government. Anyways, it is artificial value, right? Students, I hope all this is clear. So we are in step 2, we are applying PGP provisions. And in PGBP, we have studied the credit side provisions. Now, debit side is very vast. As I said, it covers more than 50 provisions relating to the debit side. That is what will be allowed, what will not be allowed. I have divided that into two parts. First is the golden rule and exceptions to the golden rule. And then is some restrictions and disallowances. But this we'll study in the next lecture because studying too many things in one lecture, it will not be digestible. So now I'll request you all to open the PDF which I have shared. In that particular case, in that particular PDF, I have taken two basic questions whereby using our reconciliation format, we will study how to compute PGBP income. Now, those are very basic questions, students, but yes, to give you a start and to give you an experience of how this particular computation works, I've taken these two examples. So problem one, this is the P&L given with some adjustments given below, right? Please ignore if there are any small mathematical errors of adding and subtracting. Please ignore that. So this is question one, this is question two. We will try to cover at least question one today in the class, but I'll give you a chance. I've already explained you what you have to do. You have to refer each side first. So step one is first refer each side. Now, when I refer each side, gross profit, obviously it is coming from the difference of sales and purchase, which is part of business, no problem. Interest on FD. Now, this is part of other sources. So it should not find place in PGBP. What I will do, I will reduce it because it is a credit item. And if it is not finding place in PGBP, we have to reduce. So similarly, I'll put this minus sign on all the items which are on the credit side, which do not find place in PGBP. Correct? So you'll check up to here, all the items, each item you'll check independently. And if you feel it is not a PGBP item, you'll put a minus sign. Similarly, you'll go to debit side. You'll check each item of expense. Now see, generally by the names, if they have given salary, we presume it is a salary paid to your business employees only, not to any of your household employees until unless specified. Advertisement, we assume it as advertisement of business. Repairs, maintenance, insurance of business asset, depreciation of business asset. So until unless for these common expenses, anything is specified, you presume these are business related expenses, right? Now, wherever you find something is not business related, like personal tax, you will put a add sign. Why? Because if there is anything which is debited to P&L but not covered in PGBP, then we already checked it has to be added. Now, after or alongside this, you will also read the adjustments because some items may have different amounts. For some items, the details are given in the form of additional information. And on the basis of that, you will determine again whether to add or subtract it and what amount to be added or subtracted. Fine, students? I give you 5 minutes. After that, we'll discuss what to be added, what to be subtracted. Fine. Till then, I'll take a short break of 5 minutes. You all till then do the markings. Okay, so let me check. So this is less, less, this is less, less, less. Now for sundry receipts, let's see if there is any clarification. Yes, fifth. It relates to sale of scrap arising from business. Now, since it is relating to sale of scrap arising from business, we will keep it in business only. It will not be adjusted. So two items are as it is, no adjustment. For remaining these and this, it will be less. Correct? Pranav, better debit side salary is your business expense. Now, credit side salary, Pranav, is your income. And credit side salary cannot be related to business. Salary is always arising out of your job only. Correct? Now, for debit side again, we will have to see if there are adjustments. Yes, first adjustment is debit side salary includes 300 paid to domestic servant. Now, as I said, this expense, if nothing is specified, we assume it is arising from business. However, out of this, 3,000 is relating to domestic. So that is a non-business expense, add. Similarly, repairs include 3,500 repairing to residential house. If again it is of residential house, it is not a business expense. So that 3.5 is to be added. 3,500 to be added. Now, depreciation as per income tax provisions is 42,000. However, here what is debited is 36,000. Now, the difference of 6,000 will be subtracted and not added. Same logic. See, this is PGBP, this is accounts. Accounts, it is less by 36, PGBP less by 42. So you have to come down. So see, everything on debit need not always be added. Here, since the difference is more in income tax, that is why it is to be less. GST is again a business expense. It is allowed. Legal charges allowed. 1 second, I'll just check for the... Okay. So see, salary allowed except for 3,000. Advertisement allowed. This repairs allowed except for 3,500. Depreciation allowed for the amount adjustment. Rent allowed. Personal tax not allowed. It is already added. GST allowed. Legal charges allowed. So what I'm saying is allowed means they are business expense. They will be as it is in PGB, no change. Now, audit fees also allowed. Customs duty also business expense. Loss of machinery, it is capital head item. So it will be added. All debit side items which are not finding place in PGBP, add. Administration allowed. Yes, there is some adjustment. I'll come to that. Interest on capital. See, capital means proprietor's capital. You cannot earn from yourself. So this cannot be an expense because you are paying interest to yourself, which is not allowed. So add. Bad debts, again, business expense, so allowed. So broadly, as per the names, these are all disallowed, which I have put as add. Now let me go to the adjustments. Now these are the technical adjustments which you will study in the next lecture as per the respective provisions. Right now, I have already given the final answer. Final answer means I have directly concluded that administrative expense includes 10,500 disallowed as per 40 clause A. Now, what is disallowed in 40 clause A, that we'll study in the next lecture. Right now, I just want to give you a feel of the sum solving. So, if out of administrative expenses, 10,500 income tax law does not allows, in that particular case, 10,500 becomes disallowed. So what you will do is you will add that 10,500. Where is this item? Yes. So in this 35, there is some amount included which is not allowed. So this 10,500 I'll have to add while computing PGBP. Correct? Similarly, sundry receipts adjustment is done. Now this expense of 9,000 eligible as deduction under 35 is not recorded in P&L. Now this is interesting. There should be some expense, but it is not recorded in P&L. Now this expense not recorded in P&L, but is allowed as deduction under the business head of rupees 9,000. So see this. Business head allows deduction of 9,000. So business profit should be less. P&L has not considered it, so P&L will remain here. So I'll have to come down. So I'll have to reduce 9,000. So expense under section 35. What it is, you will study in the next lecture. For the timing, I'll just inform you it is scientific research expense. So this is how we solve the sum. We identify in the P&L what are the items, to what extent they do not find place in PGBP, that we have to simply add or subtract from the net profit of P&L to arrive at the PGBP answer. Is this clear to all students? Yes. Is this clear to all? Is this understood? Excellent. See, PGBP generally students find very difficult, but let me tell you, you'll find it very interesting. Yes, it will require efforts to learn, no doubt. It will require efforts to keep so many provisions in mind, but it is going to be fun, right? Company can invest and have dividend. Can you brief? Yes, but a company is allowed to invest in other company shares, so you can get in dividends. No? There may be restrictions in company law, but it is not debarred. So you can get dividends even if you are a company. What about adjusted depreciation? Preeti, I did not understand what is adjusted depreciation. Bhavna, what you are saying? Sukhvir, credit side salary be deducted because on credit side, the salary which is appearing is salary income, which will always fall under the salary head, because whatever salary you receive as employee. It cannot be part of your business. Preeti, so we have already done the adjustment of salary of depreciation given in adjustment. Now we found the difference of that 6,000 and we adjusted 6,000 for depreciation, Preeti. Beta, we deducted dividend because dividend Shruti is falling under other sources head. We only want PGBP income. Correct. So we are removing all those incomes which fall under other heads so that we only are left with the PGBP item. Yes, beta. Hardik, everything will be by this Heinz approach. Beta, interest on capital is now this person is a proprietor. In accounts also, you cannot pay income to yourself. How can you show income to yourself as income in one head and expense in other head? So it is not allowed. Even in income tax, I cannot say that I am paying interest to myself or rent to myself. So that is why interest to on capital, that is on own proprietor's capital, cannot be a deduction. Riddhi, I hope you understood. Manoj, even if only 3 adjustments are wrong out of so many, it means you have done very well because this is the very first sum of PGBP. Bhavna, beta, no problem. Take some time. It is not expected that everything will be understood in one go. Be patient. Try to revisit this lecture again once it is uploaded. Maybe you can only come to the last half an hour part. No problem, Bhavna. It is not expected that everything will be understood. No problem, Manoj. See, beta, you have to understand what is idless. You can understand it by any technique. No worries. We'll practice again. We did this in costing also, Manoj. Even if it is not understood, we will try it again. Don't worry. See, please, students, don't expect everything will be understood in one day only. Right? Yes, Kasak, I'll check the illustration 7 and in the next lecture, we'll discuss on that. Fine, students. Sorry, today I'll take your leave immediately because I immediately have a member session exactly scheduled at 5. So thank you very much, students. It was really a great lecture, a very good interactive lecture. Please go through PGBP and study it from the module till our next lecture. You may or may not understand, not a problem. Don't worry. Fine, I'm there. I assure you in 4 sessions, you will be expert of PGBP at least to 90% extent. And that is more than sufficient for exams also. And in future, you can cover other balance 10% when you are in articleship. Fine, students. Thank you all. Take care. Bye-bye. Technical team, thank you very much. Technical team, thank you. Thank you, students. Bye-bye.